lot of people misunderstand taxes, the psychology of taxes, investing in your business, spending outside of your business. This isn't tax advice, but it's just what's worked for me and how I think about this. So I got to start with a little bit of a throwback to my childhood. Anytime I wanted to buy something, my mom, she'd be like, "Hey, Andrew, are you sure you want to buy that?" And I'd be like, "Yeah, it's $10. And she's like, no, it's not. That's $14.50. I was like, "Well, what do you mean?" She's like, "Well, when you think about, you have to earn $14.50, then you have to pay taxes on that. So it's not really $10. You have to earn way more than that to be able to afford it on an after-tax basis. You should always be thinking about everything as an after-tax expense or an after-tax investment. The government actually is subsidizing you to invest in your business. But when I started thinking about it on an after-tax basis, the price after tax to me is dramatically lower. So if you're looking at $100,000 investment and you know your marginal tax rate is 30%, don't think of it as $100K. Think of it as $70,000. For some reason, if you think of it as just as a write-off in general, you think of it as free money. And that's not the case. You're still spending a certain amount of money on this, even on an after-tax basis. So try to think about everything in dollar terms after tax. It's really important to understand the nuances around your effective tax rate and your marginal tax rate. Effective tax rate, this is your average tax rate. It's pretty much how much you paid in total taxes divided by how much your income was for the business. But this can be very misleading, especially the more you make, because at least in the US, you've got a tax rate that gets increasingly higher the more you make. And your marginal tax rate is the tax rate you spend on each incremental dollar. When you're thinking about, should I make this investment or should I not? What you really want to focus on is on the marginal tax rate, because those incremental dollars, your average effective tax rate doesn't apply. Your marginal tax rate does. You should be thinking about that on your federal level and your state level. That's the rate you should be measuring all those incremental purchases or investments against. The other thing is not just on the tax side, but on understanding the difference between different types of income and how they are taxed. So for example, if you look at a 5% yield on that income in the high yield checking account versus let's say a 7 or 8% yield or maybe a 10% yield on stocks long term, you can't just compare the yields, you got to compare the difference in tax rates as well, because those stocks are so much more tax advantaged. When we're in the middle of massive success with a business, we tend to think that's going to last forever. Sometimes it doesn't. The more money you make, the more sense it makes to invest. If 50% of the money you are making is going to the government, is something you're never going to see again, then it makes a ton of sense to give raises to your teams. If your employees are overall tax rates can be 20%, you're paying 50%. It makes a lot of sense to be more generous than you otherwise would be, because that 30% is surplus that's going to them versus just the government in general. So I think that's something that's really important to think about. The more you make, the more it makes sense to invest in your business, to give, and to be generous. And then how do you balance deep business ambition with also a really rich, amazing life outside of business? If you go from 25% tax rate to 50% tax rate, effectively, you're having your efficiency in terms of generating income is going down. The more money you make, the more sense it makes to think about how much time you're working versus putting other things in your life. Because if you trade an hour for work at that 25% rate versus a 50% rate for an hour of pleasure, effectively, your hour of work is way less valuable because you're paying more taxes at that higher tax rate. So if you're thinking about trying to scale quickly, sell this thing, completely disregard everything I said. You're playing a different game. If you're in a business where you want to stick around for a while, you love what you do, then this is something that's really important to think about. Finally, when you have to pay your taxes, write your checks and stop whining. If you live here in the US, you live in a country where a lot of other entrepreneurs throughout the world would kill to be able to live, to operate, to access this market, to have some of the rules of law here that we have to operate a business here. I know someone who every time tax time comes around, there's this black cloud that goes over their head. I understand a little bit of that. Like, I have some issues with how the government spends my money, but you can't control this. So don't let it completely derail you. If you're writing checks to the government, it means you're making money. And the bigger checks you're writing in general, the more money you're making, which is a great thing. Think about how you're spending your time and your money and your investments and your expenditures carefully, but then write the check, move on with your life, and be thankful we got an opportunity to run an amazing business in a country like this. So I hope this is a slightly more nuanced, or at least a little bit of a different take than what you've probably heard out there about taxes. It's a super important, interesting topic, and hopefully it saves you a little bit of coin and maybe heartache in this coming year.